In early 2023, the American banking system appeared calm and structurally stable on the surface despite rising economic pressures. Markets were adjusting to higher interest rates after a year of aggressive monetary tightening across the economy. There were no visible lines outside bank branches, no emergency warnings, and no immediate signs of institutional distress anywhere. Most Americans assumed their deposits were secure and protected by regulations, strengthened after the financial crisis of 2008. Then within just a few days, one regional bank collapsed at a speed modern finance had never experienced before. Billions of dollars moved with a few taps on smartphones, and confidence evaporated across the system almost overnight. The broader economic environment had already shifted significantly. Long before the collapse occurred, interest rates had risen sharply throughout 2022 in response to persistent and widespread inflation. Higher rates increased borrowing costs across mortgages, auto loans, credit cards, and business financing nationwide. For households, that translated into tighter budgets and noticeably larger monthly payments. For banks, it created a more structural problem as older low-yield bonds steadily lost market value while new bonds offered higher returns. Many regional banks had invested heavily in long-duration treasury bonds and mortgage-backed securities during years of near-zero interest rates. As rates climbed, the market value of those bonds declined across institutional balance sheets. These losses were largely unrealized, meaning they existed in accounting valuations but were not immediately realized as cash losses. However, unrealized losses still reduce financial flexibility and strategic options. They limit a bank's ability to sell assets quickly without directly impacting capital strength. At first, daily operations across affected institutions continued normally without visible disruption. Depositors check balances through mobile applications and online platforms without concern. Payrolls processed on time across thousands of small and mid-sized businesses. Startups continued relying on their banking partners for working capital and operational liquidity. From the outside, nothing appeared unstable or structurally compromised. Then scrutiny intensified as analysts began highlighting the growing gap between bond market values and reported book values. Financial observers raised questions about capital positioning and interest rate exposure. One prominent regional bank announced plans to raise new capital to reinforce its financial stability. The move was procedural and technically sound within regulatory guidelines. The reaction from markets and depositors, however, was far more aggressive than anticipated. Large depositors began reassessing their exposure to concentrated regional institutions. Venture capital firms advised portfolio companies to diversify deposits across multiple banks. Corporate treasurers initiated transfers as a precautionary risk management measure. What began as caution gradually accelerated into coordinated action. Digital banking fundamentally changed the speed and scale of unfolding events. Within hours, billions of dollars left a single institution through electronic transfers. In previous decades, bank runs required physical presence and unfolded gradually over time. In 2023, withdrawals occurred electronically, simultaneously and at unprecedented speed. Liquidity pressure escalated beyond traditional stress test assumptions built on older behavioral patterns. Stock prices fell sharply as investor confidence weakened further. Credit rating agencies reassessed institutional outlooks under compressed timelines. Media coverage intensified as uncertainty spread rapidly across financial markets. Confidence deteriorated in a way that proved increasingly difficult to stabilize. Withdrawal requests surged into tens of billions of dollars within a single operational day. Liquidity buffers proved insufficient to absorb the pace of coordinated outflows. Regulators intervened and placed the institution into receivership to prevent further destabilization. It became the largest U.S. bank failure since the global financial crisis of 2008. Within days, another regional bank collapsed under similar structural pressure. Regional banking stocks declined broadly as markets reassessed systemic risk exposure. For many Americans, the phrase bank run returned to public conversation and financial headlines. Businesses questioned payroll continuity and access to operating capital. Depositors reviewed federal insurance limits and evaluated account protection levels. Financial markets experienced renewed volatility amid rising uncertainty. Emergency measures followed quickly in response to escalating liquidity stress. Regulators expanded liquidity facilities, allowing banks to borrow against high-quality assets at full face value. Deposit protections were extended for affected institutions. To restore depositor confidence, large national banks saw significant deposit inflows as customers sought perceived institutional stability. The immediate panic phase gradually slowed as liquidity conditions stabilized. However, the episode revealed deeper structural vulnerabilities within the regional banking framework. At its core, the stress exposed how regional banking liquidity models depend on stable deposits and balanced asset durations. Banks operate on a fractional reserve framework, meaning most deposited funds are invested rather than held entirely as cash. That structure functions effectively when withdrawals are predictable and distributed over time. It becomes fragile when large groups withdraw funds simultaneously and without delay. The first structural weakness involved interest rate exposure embedded within bond portfolios. Rising rates reduced the market value of long-term bonds purchased during low-rate periods, when those bonds must be sold before maturity. Unrealized losses convert into realized capital impacts. The second vulnerability involved deposit concentration within specific industry ecosystems. Certain regional banks relied heavily on large uninsured deposits from technology startups and venture-backed firms. These deposits were sizable and behaviorally aligned during stress events. When concerns emerged within that network, withdrawal decisions moved collectively and rapidly. The third weakness centered on limited interest rate hedging strategies. Some institutions did not fully protect against rapid shifts in bond yields and market conditions. Asset durations extended while funding sources remained short-term and highly confidence sensitive. This duration mismatch amplified liquidity risk during periods of sudden withdrawal acceleration. Digital velocity magnified every structural weakness simultaneously. Information spread instantly across social networks, investor groups, and messaging platforms. Online banking eliminated physical friction that once slowed withdrawal behavior. What might have unfolded gradually over weeks compressed into hours under digital acceleration. Stress testing models based on historical withdrawal speeds underestimated this modern behavioral shift. Once confidence declined, cause and effect sequences tightened dramatically across the system. Capital concerns triggered heightened scrutiny from investors and depositors. Scrutiny triggered increased withdrawal activity. Withdrawal activity triggered liquidity stress within vulnerable institutions. Liquidity stress triggered decisive regulatory intervention. Markets responded with measurable but contained volatility. Regional bank equities declined sharply before stabilizing as liquidity assurances improved. Treasury yields fell temporarily as investors shifted towards safer assets. Credit spreads widened as financial risk premiums increased. Venture funding slowed further amid uncertainty in credit markets. Financial conditions tightened across lending environments nationwide. That tightening extended beyond banking institutions into the broader economy. Small business lending standards became more cautious across regional markets. Commercial real estate financing faced greater review and risk evaluation. Startups slowed hiring and reduced discretionary spending to preserve liquidity. Mortgage underwriting standards tightened modestly under revised risk models. Households experienced indirect effects through slower job growth and retirement account fluctuations. Importantly, deposits within insured limits remained protected throughout the crisis. No widespread retail depositor losses occurred across the system. The broader banking infrastructure continued functioning, despite localized failures. However, credit availability tightened and institutional risk tolerance declined. In the months that followed, structural adjustments began across the sector. Deposits migrated toward larger national institutions perceived as more stable. Regional banks increased liquidity buffers and reassessed duration exposure. Risk models were updated to incorporate digital withdrawal velocity scenarios. Interest rate management became more conservative across portfolios. Funding diversification gained renewed emphasis within risk frameworks. The 2023 banking collapse differed structurally from the events of 2008. It was not driven by widespread credit defaults or complex derivative exposure. Instead, it reflected how rapid monetary tightening, concentrated funding structures, and digital acceleration can converge under stress. For US households, the implications were structural rather than dramatic. When banks tighten credit, borrowing becomes more difficult across sectors. When lending slows, hiring often slows as well. When uncertainty rises, investment decisions are delayed. Even without direct deposit losses, financial tightening influences everyday economic conditions. The system ultimately absorbed the shock and stabilized. Liquidity facilities reduced short-term stress across institutions. Capital levels across major banks remained above regulatory minimums. Confidence gradually returned, though awareness of structural risk increased. Long-term uncertainty remains dependent on several evolving variables. Future interest rate movements continue to influence unrealized bond valuations. Commercial real estate loan performance introduces additional pressure points. Deposit behavior under renewed stress remains difficult to predict. In a fully digital environment, confidence remains the foundational pillar of modern banking systems. It does not appear directly on balance sheets, yet it determines stability more than any single asset. When confidence holds, liquidity circulates normally throughout institutions. When confidence weakens, speed becomes the defining risk factor. In 2023, velocity defined the crisis dynamic. Funds moved faster than historical models anticipated. Information traveled faster than institutional response mechanisms. Liquidity stress unfolded faster than previous precedents suggested possible. The episode was not a systemic collapse. It represented a structural recalibration within a rapidly evolving financial environment. It demonstrated that in a digitally connected economy, financial systems must adapt to new behavioral speeds. Understanding those mechanisms provides clarity and long-term perspective. Future disruptions may differ in trigger, but the mechanics of confidence, liquidity, and structural exposure will remain central. If you value measured system-level analysis of the forces shaping the American economy, consider subscribing.